Super. So I'm presuming that I'm audible and I'm visible, and you can see on the screen, Dean as well. So good morning, folks. A very warm welcome to another round of Walk the Stalk. This time we've got a very special guest. We've got our own Dean Kim, Executive Director at William O'Neill. And why we wanted to get Dean was the O'Neill methodology that we've been speaking about for so many years, that you've been hearing through webinars, reading through transcripts, reading through our newsletters, research reports. Dean, I think, is a master of it. I think he's seen it, he's done it all. He's with the William O'Neill Group for a long time. He's an executive director with William O'Neill. He has extensively studied a lot of sectors, including the banking sector and a whole host of other sectors as well. And just as a biography to what Dean has done from a professional perspective, he holds a BS in engineering from Yale, and he's earned his MBA from the Columbia Business School. I would admit that Dean has made it special for us because he's stayed up pretty late in the night back in the US to speak to us live. So I think thank you, Dean, for taking our time to speaking with us and speaking to all our patrons as well. Welcome to Walk the Stalk.
Yeah, thank you. Thank you for the introduction. Pleasure to be here.
Super. So Dean, I think as we were speaking just before we entered onto this chat, the global setup, Russia, Ukraine, I think the crisis intensified over the last couple of days. The markets had a knee-jerk reaction. They have rebounded very smartly. So as a follower of the O'Neill, let's say generally as a follower of the macro trends, how are you viewing the global setup at this point of time? Is the worst over, or are we bracing for some more events to follow on a macro scale at this point?
Yeah, so a lot of things going on. And basically, this whole geopolitical situation has created a knee-jerk reaction in the market. Yeah. The past couple of days, today and yesterday, the reaction in my mind is sort of a signal that the Fed may be, taking a more dovish approach in the next Fed meeting. So, right now, as you know, they've been trying to deal with inflation. And they were talking about or signaling, as much as 3 rate hikes this year, 3 rate hikes next year. Because of the geopolitical situation, they may be walking that back, and maybe that's what the market is kind of pricing in at the moment. So we'll see by Tuesday whether we're going to have a follow-through day, because Tuesday will be the 4th day, so. If we do get a fall today, we would continue to stay patient and just look for setups in the market or for the stocks for proper entry points, because history has shown us that, all follow through days, they don't necessarily work. So this will be the second fall through day we've had. And should we fail at the second fall through day, then I think we should be bracing for a much more violent and negative reaction in the market. But hopefully, this follow through day is going to work.
Super, I think so. Thanks for setting this up, Dean. Now, with the comments that you've made, let me just break this into 3 or 4 broad questions. On the Fed meet that you said, the market is now bracing, as you said, for a lesser hike. So I think was a 50 bips hike initially anticipated, now converting into a 25 bips right now? And would they go slow in their rate hike trajectory itself? If so, have the markets gestated that with the move that we've seen in the last couple of days? Or is there some more to come?
I think that's a reasonable scenario. If they were to increase it by 25 and then slowly increase over time, that would be like a Goldilocks situation for the market. Then I would say, the follow through day is going to stick, it's going to work, and we're going to be making new highs. If they continue on the path of aggressively raising rates, like 50 basis points in March and 25 basis points every quarter or every couple of months, then we're in a situation where the market's going to have to rethink, where we are in terms of valuations. Valuations are going to continue to come down in that scenario. So I think it's going to be very important for us to pay attention to the next Fed meeting.
Oh, absolutely. It makes absolute sense of that. But just as a follow through in terms of how the US Feds are placing their bets on the rate hike vis-a-vis the inflation that we all are seeing has become extremely concerning for global markets. Now, we did carry our global banking report, Dean, and in that we categorically mentioned that inflation has gotten beyond the threshold for most European nations, most Latin American nations, the US as well, India, Indonesia, also very, very close to the upper end of the range. So do you feel that inflation is sticky at this point of time? If yes, what is the central bank stance on that going forward?
Yeah, I mean, it appears to be sticky because, as you know, Fed has continuously said last year that they expect inflation to be transitory, but we haven't, seen inflation back down. We continue to see, close to 7% now.
Yeah.
And, when oil is spiking because of the geopolitical situation, that's also going to contribute to inflation going forward as well. And so some people are thinking, we could see 10% inflationary rates in the US,
Okay.
If oil continues to climb.
Sure.
If that's the case, then I think we can categorically say that inflation is here to stay. If that's the case, then central banks around the world, they're going to be forced to raise rates. That also speaks to, economies running hotter than expected, in which case, it's great for banks. And that's what we were thinking prior to this Russia-Ukraine conflict. So we were expecting the banking sector to do quite well this year. Because of reflation in all of the economies, as well as central banks raising rates. But we'll see what happens, because right now I'm keeping a close eye on XLF, which is the ETF for money center banks in the US. Okay. It's sort of holding support. It's consolidating at the moment. But as long as we hold above, January lows, I think we're fine. If the banking sector starts to deteriorate, then I think that's a signal that U.S. is headed for a lot slower growth than what people had originally expected, and so I think we need to see the banks perform in line, at least. Hopefully, they can break out and outperform, but. We need to see the banks, holding in. Otherwise, the whole market will be in trouble.
Well, absolutely. So we'll take the banking sector and the other sectors in the latter part of our conversation, Dean. But just the points that you have right now raised. So inflation might be one of the most prominent issues that can probably drag earnings down and pose an outside risk to the market. Is that what the feel is?
Yeah, that's kind of the feel right now, because like in the US, the inflationary problem is particularly a thorny problem. It's not really going away. Now, one could argue, it's there's a lot of supply constraints out there.
Yeah.
And so is this inflation artificial in a way? I mean, in other words, is there truly a demand that would offtake the supply in this environment? If we take away the supply constraints, do we actually see demand that's willing to take up the supply, or is there no demand? So that's something that we don't really know at the moment. But certainly, whether it be supply constraints or outside demand, we are seeing prices going up. So the central banks that will have to deal with that.
Oh, absolutely. So I think this is one area that I think we should all be looking forward for, as per your comments. Now you spoke about the follow-through, Dean. I just want to let a few of our other users, or that CANSLIM or O'Neill users who joined onto our chat, that what Dean meant by a follow-through day was that what O'Neill methodology suggests that once a market gets into a downtrend because of an increase in the distribution days, and once we have hit an intermittent bottom, if for 3 days, for 3 consecutive days, that bottom is not breached, you go into a rally attempt and then you wait for the follow-through day, which is basically an index or one of the major indices moving 1.5, 1.8% or more with volumes better than the previous day or above average volumes, giving confidence that a lot of supply-related pressures in the market are largely over. So I just wanted to give the background about the follow-through to a lot of non-CANSLIM users. Now that we've got this background in place on what a follow-through day is, how the bottoming out process is identified as per the O'Neill lens, do you want to just take the investors through your note in terms of how the setup is right now and what we spoke before the chat in terms of how the earlier follow-through days, if they miss out, if the second follow-through day, you just pointed out in your opening remarks, gets a false, we do get a false second follow-through day as well. What are the implications there? So if you just want to take
Right. So, if you look at the S&P and the Nasdaq, we basically undercut the first follow-through day that we've seen, I think around January. We've undercut that on Wednesday. And so we've basically reset the clock back down to zero, and we start counting from that point on. We had a good day on Thursday and a good day today as well. So we're on day 2. So Monday will be day 3.
Yeah.
And if we happen to stay above that low point on Wednesday, we will, as you suggested, go to rally attempt. And then Tuesday will be the first opportunity where we could see a follow-through day.
Absolutely.
So follow-through day for us is very important because Bill O'Neill has done the study going back, to 1900. Actually, our strategist, Kenley Scott, did a study going back to 1970. And when we look at the 26 corrections that we've had in the last 50 years, and we look at the follow-through days, basically 18 times we've had a successful follow-through day, and where the market has made a new high. And that's only, that's after like the first follow-through day actually working. And a good example of that is 1996 as well as 2014. You can kind of go back to the charts and take a look at during those times. Now, there's cases where first follow-through day fails, like we just did in January. Second follow-through day actually works, and that occurred 8 times in the last 50 years. Great example of that is 1998 as well as 2018. So if you go to 2018 and you look at the chart, you can see where we've this was fourth quarter 2018. I distinctly remember that.
Yes.
That was around December. We made a low, and then we've actually undercut that low. But then after that, I think it was day 11 follow-through day, the market actually worked, made a new high. Now, there are cases where even the second follow-through day does not work, and we undercut that. Then we're talking about bear market territory.
Sure.
So that's why it's so crucial for us to see this follow-through day that we're approaching now. We need to see that work, because if it fails there, chances are we're going to be going a lot lower. And when you look at back to 1970, we've actually had 7 times where those second follow-through day actually failed. Great example is 2007 to 2009. During those 2 years, we've had 7 follow-through days that actually failed, and on the 8th follow-through day, that actually worked. And during that time, the market shed a lot in terms of percentage underperformance.
Absolutely, I think that was very, very informative, Dean. So guys, if you have noted this down, I think Dean has given some brilliant insights in terms of follow-through days and why follow-through day is very, very important. So I think we need to wait for that FTD to come through to sufficiently help us believe that the markets might be heading northwards. Now, you spoke about the banking sector, Dean. A lot of people get skeptical in an rising interest rate scenario, and they feel that banks will also get hit because of rising interest rates. Now we've done a global banking report as well. You yourself were tracking the banking sector very, very closely when you were back with your earlier organization. So what is your take? Does a rising interest rate scenario mean that banks really get hampered, or do you think that becomes a golden opportunity for banks in this case?
Yeah, usually what happens is, when the economies are ready to reflate, let's say they're coming out of a trough in terms of economic growth. Usually what we see is the 10-year bond yield actually making the first move. They start rising, okay? And that's because the bond market is estimating that, okay, we made a trough in the economy, things are looking pretty good, and we think the economy is on a trajectory for growth now. So that becomes reflected in the 10-year bond yield. And actually, if you compare that to US banks, there's a very high correlation. US banks trade very closely with the 10-year bond yield.
Okay.
Because the 10-year bond yield is telling us where the economies are going.
Sure.
And for banks, it's all about economic growth. And so
sure.
Banks will, rally when 10-year bond yield creeps up. And then the second phase is the Fed or central banks realizes that, the economy is running hot. We're going to have to start raising rates at some point because they're going to have to battle things like inflation, rising asset prices. And one of the things that they can use is the monetary policy by raising rates. So when, central bank starts raising rates, that's actually a good scenario for the banks. And that's because they can start to reprice new loans at a higher rate because they're taking the cue from the short-term market rates, okay?
Sure.
So you have long end of the curve starting to rise, and then you have the short end of the curve starting to rise. So that's the sweet spot for banks because the economy is looking good, and also short-term rates are rising. So therefore, it gives them an excuse to raise their rates for new loans, and that's how they expand their net interest margins, right? So in that scenario, banks should be able to outperform, and that's what we were kind of looking at prior to this geopolitical situation. Yeah. Banks were across the globe was actually looking fairly good. In fact, some of the banks on our focus list, like Taiwanese banks, Singapore banks, Indonesian banks, they're doing quite well because they're kind of insulated from what's going on in Russia and Ukraine. Yeah. At the same time, their local governments, they have to deal with rising inflation, and they're starting to raise short-term rates. So that's all being reflected in those stocks. Now, banks in Europe, we've actually had to take several banks off our focus list. Yeah. Because obviously with things going on, for example, we had a Polish bank, OTP, actually a Hungarian bank. We had to take that one off the list because there's too much close ties with Eastern Europe. So that's all being reflected in the stock price. And so we had to take that off. But when all of this geopolitical situation settles down, I think we're going to be back towards these banks because number one, valuation-wise, they're amongst the cheapest in terms of the sectors. Sure. And number two, hopefully the economies will continue to be on that growth trajectory relative to last year, and so therefore, central banks will be supporting rate increases. So that's what we're kind of looking forward to right now.
Well, absolutely. So, folks, I think if you would have heard Dean, I think very logical arguments on why banks should do well, even in a rising interest rate scenario. But what we've seen, Dean, I think historically, and this is what I have observed, that whenever we come close to an interest rate reversal cycle, I think the sentiments get hit first, specifically in a US Fed rate scenario, and then the banks start moving. Have you observed that as well? I think the sentiments get hit first, and then the banks perform.
Yeah. Sentiment is definitely getting hit at the moment. And but you know, like if you look at 2016, all of a sudden the bank sector, they started to rally, and that was a new phase where the Fed was done with tapering, and they were ready for new presidential administration to come in.
Sure.
The economy was looking for, or the market was looking for the economy to expand going forward. So the long end of the yield curve that was rising, and soon thereafter, the Fed started to raise short-term rates, and so that's when we start to see the banks starting to outperform. So that should be the normal scenario.
Yeah.
Right now is sort of abnormal because now we have to deal with Russia-Ukraine situation.
Sure.
But like I said, I think once that dust settles, then we can kind of reevaluate where the banking sector is.
Oh, absolutely. Point taken, indeed. Just to follow through in terms of what you mentioned on crude and gold as well. What is your take? Is this crisis going to ensure that crude still stays above that $100 mark, or do you feel it should soften out a bit?
Yeah, in the short term, I think crude is definitely going to test $100, all right? Because in a panic type situation, there's going to be pressure to hoard commodities. And so we are seeing that at the moment. So Brent price heading towards $99, $100. WTI also at 102, 103. So I think, we're probably going to head towards that $100 mark. Now, from what I understand from the readings that I've done, oil was already in a tight supply situation. So globally, oil producers, they just haven't been pumping out a lot of oil. So we were already in a tight situation, but my understanding is second half of the year, we should see more supply coming on. So therefore, oil price will likely start retreating in the second half of the year. But for now, definitely we are seeing short-term spike because of the situation currently.
Well, absolutely. And what's your take correspondingly on gold as well, Dean, if you have any comments on?
Yeah, I mean, when I look at the gold chart, GLD is the ETF. It's broken out, right? It's a classic, O'Neill methodology breakout. That just means that there's a lot of institutions hoarding gold at the moment. It's only natural, it's the safest asset that you can find in situations like this. And actually, coincidentally, Bitcoin is acting more like a high growth asset. It's everybody thought Bitcoin would be a good hedge, similar to gold, but it's not behaving like that. So I found that to be quite interesting.
Oh, absolutely. Point taken. Now let's turn our focus, Dean, a little bit towards emerging markets and then specifically on India as well. We also carried out a report on our global team did carry out a report in terms of the emerging market ETF and how the expectations of India, Indonesia, Taiwan holding it up seems to be a case for specific economies within that. So do you still feel that India, Indonesia, Taiwan within the emerging pack can?
Oh yeah, I love the Indian market. I love the setup because I can't find any other country that, for example, household debt to GDP is quite low. It's super underpenetrated, and there's a rising middle class happening in India. And you can see it from all these retail companies, whether it be beverages or fashion, retail. Titan, if you look at Titan stock, it's just going really well. That kind of shows you the power of the society and how well it's doing. And so I think India is in a great spot. And as a banking analyst, I get excited too, because when I look at HDFC Bank growing 20% organically every year, you just don't find that in any other countries. It's very, very hard to find banks that's growing in such a pace. And they're managing, asset quality really well. And so, yeah, I think India has a lot going for itself. Emerging market, and I would say India is in a far better place than some of the other countries, like Southeast Asian countries. They're just not big enough. The economies of scale really matters, and India has the domestic capability to really grow their GDP growth. So that's quite different from other countries. I think the one thing that we have to keep in mind is where oil price is going. Obviously, India is a net taker of oil, and so when oil prices spike, it's going to cause some deficit in the market, and that may trigger inflation as well, because Indian rupee tends to depreciate in that situation. But I think that's going to be temporary. Like I said, oil price is expected to retreat in the second half of the year, and so that's going to be great for India.
Well, absolutely. I think very positive comments from you. And since you cover the Indian markets and stocks very, very closely, we'll come to that as well. Just to remark on the oil prices itself, Dean, our average basket in India for oil 9 months is $73. We are already at 100 right now. So you're absolutely right in terms of the outside risk. Just a stat, one more stat, I think 18-19, we imported $112 billion worth of oil imports. We might touch that figure again because of rising prices and a depreciating rupee, as you rightly pointed out. Nevertheless, I think in terms of banking, all the other sectors as well, from an Indian context, since you're extremely bullish on banks as a whole, and since you mentioned a couple of Indian banks as well, any banks on our global focus lists which you might want to comment upon, so that our users can probably study that and probably benefit as well?
Yeah, I mean, the one bank we have on our focus list is ICICI Bank. Canary ticker is ICG.IN. That's been on our focus list for a while. It's been holding up quite well. Right now it's forming like a cup with handle base, but the handle is a bit deep, so I'm a little bit concerned there, but it's still holding above 200-day moving average, which is fine. So I would say wait for the breakout, because if the stock breaks out from this handle into pivot, that's a great signal, great time to buy. Another one that we're keeping an eye on is State Bank of India. And that one is what we would call near pivot. It's sort of consolidating at the moment, but once it breaks out into pivot, that one looks really good. I think they've cleaned up a lot in terms of the balance sheet, and so you're not getting any more of the bad loans coming through. So it looks like that's all being priced into the shares. So that looks great. Another one is Axis Bank. That's another one that we're keeping an eye on. And then one is not particularly a bank, but it's a consumer loan company, Cholamandalam. That one is breaking out now. So that one looks quite good. So I would say take a look at those names. And then just in the finance sector, in terms of REITs, there's Embassy Office Parks REITs. That one is breaking out now. Looks quite good. The growth is quite phenomenal, and the market cap is almost $5 billion US. So it looks pretty good.
Super. Thanks for those ideas, Dean. So we've always read about this, and we've always practiced about this, that whenever a correction comes, leadership comes out in new sectors. So apart from banks, what are the sectors that you are probably focusing on at this point of time, which are making reasonable basis and about to break out from?
Yeah, in India, cap equipment sector continues to look pretty good. You have Hindalco Industries that's breaking out now. Then you also have National Aluminum that looks pretty good. And then I would say Lakshmi Machine Works, that stock is quite actionable. So cap equipment sector is one that's been doing very well. Another one, continues to do well. It's basic material. So you have stock like I can't pronounce this that well, but I think it's Gujarat Namada.
Yeah, DNFC.
Okay, yeah, that one came up on my screen. That one looks really good. And then, I would say, some of the consumer names like Bardman Textiles, that's starting to break out, as well as Metro Brands and Sapphire Foods India. Those are some of the interesting names, especially Sapphire. You got the Yum brands in there like KFC and Pizza Hut and so on. It looks pretty interesting.
Yeah, so Dean, apparently I think I do get a lot of tweets myself once you give your interviews on TV18 as well, that how come this guy knows so much about Indian stocks? So I think hats off to you. I think that's a very appreciative comment that a lot of users have got back home in India. You tracking
that as
well.
I mean, our firm, William O'Neill, as you know, we hunt for growth, right?
Yes.
We love growth, and we find a lot of growth in India, in the Indian market. And stocks, they behave quite well. They, outperform in an orderly fashion. A lot of the markets, like Hong Kong is notorious. Hong Kong stocks is very volatile. You would expect the breakout to work, but it doesn't. Whereas in India, the breakouts, classic breakouts, they tend to work. And so, I think that there's a lot of good stocks in India.
Oh, absolutely. So a couple of pointers in lieu of a couple of sectors that I just wanted a view about, because they've been running hot over the last couple of quarters as well, specifically in Indian context. Real estate as a space, and you did mention embassy REITs, Dean. But do you think the core real estate, with the kind of dynamic changes that we are seeing, can still do well? Or is there an ancillary play in those home improvement players for real estate?
I mean, if you assume that rates are going to rise, then it may not be so great for real estate plays. And so I would be very selective in terms of, like, the Embassy Office Parks. I noticed that stock is breaking out in a classic fashion. So that one looks pretty interesting, but I would say avoid extended names at this point. You don't want to chase stocks that's kind of consolidating in stage 3 or stage 4 base. It's just you may be running out of time in terms of outperformance. So I would say be especially picky in that sector.
Oh, absolutely. I think those are words of wisdom, guys. So I think what Dean is indicating, that late stage basis, be very, very careful, I think, with those. The other sector, Dean, that I just wanted to point out was, along with reality, that was running hot, was metals. You did mention NALCO. Do you think there is still steep left in the sector as a whole?
Yeah, I think so, because commodity prices continue to rally. When you look at whether it be like copper or and basic materials like that, even specialty chemicals, they're going to continue to do well. Basically what's happened is 2020, 2021, there hasn't been enough capex in the world. So now, assuming we get over this geopolitical skirmish, the world is going to continue to focus on building out capital expenditures. And that's when, you're going to need commodities as well as specialty chemicals. And so I think that's going to continue to run throughout this year and next year.
So if I may ask, as a further bifurcation on the commodity play, specifically when we're speaking about metals, are you more inclined towards the ferrous plays or the non-ferrous ones?
Yeah, I would say non-ferrous ones. Okay. I think the steel prices have retreated a little bit. And they may come back, but at the moment, I would focus on more non-ferrous. Okay.
Makes sense. Now the entire theme, Dean, on the other side of the spectrum has been renewables, has been electric mobility, electric vehicles. So how do you place autos, both from a global landscape as well as the Indian market?
Yeah, Tesla has done extremely well. And in the US, if you drive around, like you'll see so many Teslas. Well, maybe it's just California. I live in California, so Tesla is great for like nice weather, warm weather, because batteries, they don't drain as much,
sure,
in warm weather. So it makes perfect sense. Yeah, Tesla has done really well, and then we're seeing all kinds of other companies coming out with electric vehicles.
Yeah.
So I think that's like a new theme globally. So you're gonna see a lot of companies benefiting from a push towards EVs. I think even in India, I think there are several companies that are starting to look into electric vehicles, right?
Oh, yes, Dean. In fact, the moment a company declares that we're getting into the EV space, that stock just zooms off. Just the word EV makes the market go crazy. But you feel there is juice. There is enough juice within the space itself.
Yeah, because when you look at the replacement cycle of these gasoline-driven cars going forward, EVs the next generation. So all the vehicles on the road eventually will be electric vehicles, and so we're just at the cusp of starting this new phase. So I think the company that can come out with really good technology, reliable, and they're able to manufacture it with decent margins, those are the companies that's going to win out at the end of the day.
Absolutely. So I think if I would have a pecking order put through for the auto space in the context of EVs, is it auto ancillaries first in the Indian context, Dean, obviously? Is it auto ancillaries first, followed by two-wheelers, passenger vehicles, consumers, or is the pecking order different?
Oh, that's a tough question, because I don't know the dynamics of like the volume, like how many motorcycle two-wheelers are being sold and so on. I would think safer bet would probably be ancillary plays, like the suppliers to the EV companies, the battery makers, or some sort of a important component within the automobile. That's probably a good space to look into. The complete EV maker itself, I think they run the risk of on some period, they go through cycles, right? Some periods the sales are really, really well, and other times when the economy's sort of pressured, consumer take a step back in terms of purchasing new vehicles. So that's something that we should probably take into account.
Absolutely, Dean. And in fact, our edge checker in the budget speech did mention categorically in terms of the battery swapping policy. So I think that is something that you also spoke about in terms of batteries. I was just reading, just a case in point, folks, and Dean as well, something on Gogoro, our Southeast Asian counterpart, and the fabulous work that Gogoro has done in terms of battery swapping. Now, two thoughts here, Dean, again, I think out of all the sectors that you probably spoke about, foreign institutional investors, and that's a question posed by one of our users as well, are still seemingly pulling money out of the Indian equity markets. So do you think this trend is still going to continue? If so, how long? And then when you...
Yeah, I mean, the Russia-Ukraine situation doesn't help, and so I think we're still going to be under pressure. A great barometer for that is to look at HDFC Bank, because the stock tends to underperform, or they go sideways when foreign investors are pulling out, and it's also being reflected in the accumulation distribution rating as well, right? But as soon as you see HDFC Bank kind of reclaim the 200-day moving average and starts to build sort of the right side of the base, that's probably when that foreign investors are starting to come back in. And so that's the way I look at the situation.
Oh, that's a great example, Dean. I never thought I looked about it that way, but I surely will going forward. So I think that's a great example that Dean gave, folks. Now, what I'll do, Dean, is I'll just toss it over to our users. So if you've got any questions for Dean, we've got the next 5 or 10 minutes that we can actually ask Dean any of the questions that you've got. So any questions related to stocks, sectors, I think Dean is here for the next 5 to 10 minutes. More than happy to answer that. So Dean will just let those questions assemble for the next minute or so, and then
Sure.
just ask user questions.
Yeah.
So the questions are stacking up. Yeah, so Rana Das, one of our users, Dean, has a question on your take on the dollar index in view of the global situation.
Yeah. Yeah, basically, I think the dollar is going to continue to strengthen, especially given the fact that the Fed is intent on raising rates. Yeah. What happens is when you raise rates, the local currency tend to appreciate because foreign money tends to flow in and they convert into U.S. dollars, and so we do expect the U.S. dollar to continue to stay fairly strong for the time being, and especially given the uncertainty, globally in terms of this situation in Europe. I think the U.S. dollar will continue to get the spotlight. Right.
Sure. One of our other users have asked your views on the IT sector, the information technology sector.
Yeah. So if I look at stocks like let's see, like Tata Consultancy, it's not looking bad. I mean, it did lose support at the 200-day moving average, but it's starting to reclaim it. So I would say, be patient with the IT sector. Right now, if I look at Tata Consultancy as an example, accumulation distribution rating is at E, which means that a lot of probably the foreign investors have pulled the money out. But when you see that accumulation distribution rating starting to increase, and the stock reclaims the 200 and the 50-day moving average, that's when you want to start accumulating. But I wouldn't do it until you make sure that the stock can reclaim the 200-day moving average.
Oh, absolutely, Dean. I think there are a lot of questions coming in now. So maybe we might need to extend a session by 5 odd minutes, if that's okay with you.
Sure, yeah.
Thank you so much. One more user has a question that because of the volatility, the breakouts seem to be very weak, and people don't have that holding capacity of more than a couple of days, assuming the market volatility. So is this a new trend, or do you think they should settle down in the next few weeks?
Well, I would wait until, or I should say, I would be patient until the Sensex, like we look at the Sensex index, right?
Yeah.
Let's make sure that we get a follow-through day in India, right? We're only day one. Today was a good day for India, or meaning Friday session. So, the earliest we're going to get a follow-through day in India is Wednesday.
Yeah.
And so let's make sure we get the follow-through day and the index can reclaim the 200-day moving average. And then from that point on, you want to slowly add to position, find the stocks that's breaking out from proper basis. Don't chase extended stocks and avoid late stage breakouts. If you just stick to those kind of basic rules, I think you should be able to do well. So right now, I would say we all want to stay a little bit patient.
Well, absolutely, point taken, and those are words of wisdom, guys. So I think being patient in these markets is extremely, extremely critical. One more user, Dean, has a question for you on Reliance. So one of the biggest weightages on the index. What's your take on Reliance?
Yeah. So if I look at the chart here, this is Reliance Industries, right?
Yes.
So yeah, it looks very similar to Tata Consultancy in that recently lost support at the 200-day moving average, but it's looking like it wants to come back. So this is probably gonna, looks very similar to the Sensex index as well.
Yeah.
So, look for follow through day on the index. Like I said, the earliest it's going to be Wednesday. And if Reliance can by then, reclaim the 200-day moving average, and particularly, if it can get over, I would say the 100-day moving average, which is at 2461. That's probably a good spot to add to position.
Oh, absolutely. A couple of users, I'll be combining this question, Dean. I think there is two separate questions, but I'll just combine this into one. One is, you did briefly mention on specialty chemicals. Do you have any particular stock on your radar there? And ethanol as a play in India has kicked off big time. So any plays within the ethanol space itself?
Yeah, ethanol, I'm not particularly familiar with. If you mention some name, I can give you my take on what the chart looks like.
Yeah, so Dean, on the ethanol story, I think you've got some classical sugar stocks like Balrampur Chini, Dhampur Sugar, and some of the equipment manufacturing companies like Praj Industries, Triveni Engineering as well.
Right. What do you know the Panerai ticker for the sugar play there?
Just a minute. It would be Balrampur, if I'm not mistaken. Just give me a minute. Just let me pull this up. I think it can be BALRAMCHIN, if I'm not mistaken.
BALRAM.
RAM.
Yeah, here we go.
Yeah.
ECH. Yeah, so this is actually on our focus list.
Yeah.
It's it's moved out of pivot, but it's finding support at the 100-day moving average. So we want to make sure it finds support there, and then break out into the pivot again. So I would add the position at above, let's call it 400.
Sure.
I would add the position at 400.
Sure.
Okay. Now, if it for whatever reason, if it breaks down below the 200-day moving average with big volume, then I would consider start trimming. But it looks like the stock looks really good in terms of holding support above the 100-day moving average, and so just keep an eye on it and add more to position at 400.
Absolutely. And there's one more if you want to take a shot at that, Dean. Praj, PRAJIND.
PRAJIND.
Praj Industries.
BRAJ.
Yeah. IND. Are you getting that?
No, I'm not getting that.
Okay, just a minute. Or maybe you want to take a shot at Triveni. TRIVENI.
Okay. Triveni Engineering and Industries.
Yes.
Okay, so this one is looking fine. It's kind of retreated again towards that 100-day moving average. So let's just make sure that it could continue to find support there, and then I would add the position at above 50-day moving average.
Okay.
Which is around 251. So above 251, I would add the position, and make sure that it can stay above 228, which is 100-day moving average.
Absolutely. Thank you so much for that, Dean. Anything from the focus lists on the specialty chemical space, Dean?
Not so much on the on that side. We have been removing some names, but yeah, I haven't really looked into it. But for example, like Linda India. So that one looks pretty good.
Yeah.
That one is chemicals based company. Looks like it wants to break out, but just make sure it can break above into the pivot zone. Right now it's sort of testing support at the 21-day moving average.
Oh, absolutely. And one last question, Dean, because there are a lot of questions, but I think we are having paucity of time. One last question from a user, Balram. Is it a good time to put money into the Nasdaq 100?
Into which area?
Nasdaq, into the Nasdaq index.
Yeah, again, I would wait for a follow-through day.
Yes.
So that would be Tuesday at the earliest. So if we do get a follow-through day on Tuesday, or any other days after subsequent to that, then I would slowly think about adding position in the Nasdaq. I wouldn't go hard into it because we want to make sure that the follow-through day works. So it may take a little bit of time to make sure that it works, because like I said, if we undercut that follow-through day, then we're looking at bear market territory. So yeah, there's a lot of fundamentally really strong names in the Nasdaq, particularly in like software security. That's one area that we really like, names like CrowdStrike and Zscaler. Those are really all, great names with high growth. Palo Alto Networks is another one that's actually setting up right now. So if you want to add a name in Nasdaq and we see a follow through day working, I would say Palo Alto Networks, PANW.
Super. So folks, I think you're running out of time, but I think you got it all from Dean, right? Macros, Indian stocks, stocks of the Nasdaq. You had asked for more. So thank you, Dean, for taking time for us. It's pretty late out there. We will definitely speak again in the next few months. And the important takeaway from Dean was wait for that follow through day. I think you just need to wait for it, have that patience, because then you'll have shorty in terms of how the markets are going to move. Thank you, Dean, once again. And thank you, folks, for attending. Good night, Dean. You guys take care as well. Thank you so much for it.
Thank you. Thank you very much.